The White House said in a statement somewhere that they don't see any fundamental value in crypto. So why is it that all of a sudden the US government is deploying literally all its resources, SEC, CFTC, DOJ, White House, I mean, the list goes on.
All in one quarter.
Right, all in one quarter.
Yeah.
Why do you suddenly care so much? Why do you spend all your resources if it has no fundamental value? What's going on, guys, and welcome back to episode 7 of Inside the WarRoom. I am again joined here by Dan Jablonski, and it's been an incredible few weeks since we last spoke because one of the biggest banking crises in US history has happened, with not just one, but two of the top 3 largest banking failures in US history happening in not just a few weeks, but rather in a single week. And today we'll dive into all of that, what happened, how it relates to crypto, and of course cover all the other angles from Metaverse and co as well. Hope you guys enjoyed today's episode, and let's dive right in. So Dan, what's been going on the past few weeks?
Well, just like you said, we've had the 2 largest bank failures since 2008 occur over the past few weeks. Of course, both Signature and Silicon Valley. And so I think that's the number one story that we kind of want to start off today. Is like, what happened and what are you kind of seeing and how are you reacting to it as a fund manager?
Yeah, the irony is I think a lot of it actually started with crypto. Now that's kind of like being hidden in the background where you only see the banking crisis, but you have to go back to like the origin, because before Silicon Valley Bank failed, which is the core story most people saw, you already had Silvergate Bank wind down. Yeah. And so essentially the timeline of events was that on, I think, Tuesday, Silvergate announced that they are shutting down. Thursday was the bank run SVB. Friday, SVB shut down. And then on Sunday, Signature shut down. Yeah. And there was a title for this, which was Operation Choke Point, where essentially, community members in the crypto world realized, wait a second, there's a lot of pressure being put on any kind of banking infrastructure that supports crypto. Yeah. And so, regulators went after, Silvergate first, and they had so much pressure, so much outflows that eventually said, you know what? We're packing up. Yeah. And the irony is that they didn't even have any solvency issues. They just said, there's no way this business will continue. Let's wrap it up. And then this started moving to more regional banks, and people started digging into like, why do banks fail? What's going on? And people realized that a lot of the banks were actually sitting on tremendous amounts of unrealized losses from the bond purchase they did when interest rates were really, really low, like 1%. Right. And they realized, wait a second, some of these banks have pretty much one-to-one unrealized losses to equity value, and just like entire book value, where they said if they lose any more, they're actually insolvent. And so nobody wants to be the last one holding back. People started running for the bank. And in no time, Silicon Valley Bank was pretty much, facing a huge problem, because with every extra dollar being pulled out, they had to realize more losses, putting them in an even worse position. Plus, the mere act of having to sell all these treasuries puts more selling pressure on the treasuries, which actually marks them down further, exacerbating the problem further.
It was also fueled by Twitter, social media, etc. A run. These weren't as prominent back, within the 2000s, early 2000s, late 2000s. Now, kind of we're seeing like that type of effect that social media can have as well too.
The additional issue is that there's only negative to staying with a bank when there's a fear of a run, right? People might say, oh, but you want to be loyal to the bank that you've been with. But there's zero financial incentive for staying, and there's 100% reward for leaving. Yeah. And I think enough people had been bruised or damaged already by things like Celsius, BlockFi, FTX, where everybody learned the hard way, if there's smoke, run.
Yeah, absolutely.
And because let's say you're wrong and everything's fine, well, what would have cost you one wire transaction? Yeah. For $25, $10, you could hedge the entire risk.
Exactly.
And so, that's what happened with SVB. But then that didn't even resolve it, because then you say, okay, this time around, the Fed stepped in, right? The FDIC took over. But even the FDIC is something you have to question, because the FDIC fund has only about, I think, $126 billion. And bailing out SVB already cost them, I think it was something between 16 to 20 billion, which means pretty much, close to 20%, right. Like 18% off the entire FDIC fund went poof for SVB. And, the government can say all they want that, like, oh, FDIC is backstopping every regional bank, but the money just isn't there.
So tell me about what the Fed did to step in and counteract this liquidity crisis, this banking crisis?
Right. Well, so you had the two angles. On one hand, you had the FDIC step in. They've got some money where they're saying, you know what, we're protecting customer deposits. And for this period, for example, they also said we are willing to protect customer deposits beyond the 250K, which was a big argument point where it became politicized, where people said, well, forever and ever you've only protected 250K. Now that it's startup Silicon Valley, you're going to protect everything. Well, where do we draw the line, right? And next time this happens, how do you do it? And so on one hand, the FDIC stepped in, but most people realized the FDIC only has so much power. And then the Fed stepped in and said, you know what, we're going to provide short-term lending facilities, essentially, whether that's 90 days to a year roughly. Because and why, right? People have to understand, like, the way these losses happen, it's not that they did crazy, toxic, risky investments, but rather they literally bought government bonds.
Because they had to. The Fed mandated that they had to buy, more less risky or safer securities, like treasuries, like mortgage-backed securities, because of the 2008 global financial crisis.
Right. And so the risk didn't come from the type of assets as much as their liquidity management, and like how they stack maturities, right? Where they realized, wait a second, most of the assets on the book are maturing in 10 years, right? And that might have been fine when they thought, wow, we got 1%, great, let's lock it in. But then all of a sudden went to 5%. And so, if you can go to the open market and buy 5% interest, why would you pay a full dollar for 1% interest? Absolutely. So naturally, even though, and that's the irony, even though all the money's still there, technically, if we all sat on our hands 10 years from now, the money's there, nothing's lost. But if you need liquidity right now, you need to buy it. Well, who's going to buy it, right? And so the government said, you know what, we acknowledge that these treasuries have real value, and we're willing to lend against them at par value, meaning if you held them till maturity, that's how much they're worth, we're willing to lend against that. And so, people in government will say this wasn't QE. They will say that it's just a short-term lending, we didn't actually print money and so forth. But ultimately, the money still has to come from somewhere. So there's two big issues with this. One is that the Fed made a bad trade, right? Because ultimately, they are willing to underwrite a loan at par value when nobody else would, number one. And then number two, the issue is that while you're solving a short-term problem, you're pretty much kicking the can down the road, because here's the issue. They're still lending to these banks at the normal Fed funds rate. And so, a regional bank might sit on, let's keep numbers simple, $10 billion in 1% interest treasuries. Now, people are running for the bank. Let's say they got $5 billion in withdrawals, right? These are numbers we've seen across the board from, whether it's like Silvergate, SVB, and so forth, right? There's mass amounts of money being withdrawn. So now the government, let's say, lends them $5 billion to hedge that out, right? So that they don't have to sell. And sure, it's better, paying an extra 4% a year in interest versus selling at a 20% loss, right? But still, you have to do the math now, where you say, okay, now they're paying a 4% delta on that $5 billion that they just lost, right? Which in this case would be something to the tune of $200 million, right, in losses that they're getting. Meanwhile, they only have $5 billion left on the books, on which they're only earning 1%, right? And so ultimately, while these regional banks might be able to get around the bank runs, they're still accruing massive losses as long as this goes on. And you might say, oh, but what is $200 million in losses when the bank has $10 billion? Well, a lot of these banks have dropped so much in stock value that many of them are literally worth that or less, right? At the peak, I believe, Silvergate Bank, I think at the peak was worth $8 billion. And by the lowest dip of it, it was below $100 million. You could have bought Silvergate, I think, at some point for like $75 million. And so, yes, realizing, in a $200 million loss, $300 million, $400 million loss because of, that spread in interest rates that you're getting, that's also causing real damage. And so I think they are kind of like slowing down the panic that's happening right now, but the problem isn't resolved. Because at some point, short-term lending's got to be short-term. So what happens when it ends, right? Do people then run again? And if they keep extending it, well, these banks are just recording more and more losses.
And so that stays to the point now on the Fed action side of, what measures is the Fed taking against this? And we saw last week that they raised the federal funds rate by 25 basis points again. Updated now forecasted dot plots are calling for 5.1 by the end of this year in 2023, and then 4.1 to 4.3 by the end of next year in 2024. What actions now in the difference between both the Fed raising their balance sheet over the past 2-3 weeks, and now also the Fed raising interest rates are really affecting this whole dilemma.
Well, the first thing I'll say, and you'll probably rarely hear this come out of my mouth, is that Jerome Powell's dealing with an incredibly hard situation. Because on one hand, you have historically record high inflation, where if that isn't gotten under control, you've got way bigger issues, right? Like if the US dollar starts going into devaluation and, you already have, the BRICS nations trying to rally behind Chinese yuan, you can't use dollar hegemony, because if you lose dollar hegemony, then the US military is going to suffer. And if the US military suffers, that's the fast path to an empire's decline.
Yeah.
And so the irony is he's actually doing the fiscally responsible thing, so to say, of being tough, right? And doing what's not comfortable, because we've been, through decades of politicians and even, Federal Reserve chairman that just kicked the can down the road to make people feel better, right? When they didn't need to, right? Like even, Bernanke, solved the 2008 crisis by, injecting liquidity, but at the same time, they kind of kept the needle in for way too long versus saying, hey, problem is fixed. Now let's practice a little bit of austerity, right? But instead they said, well, it's been one of the fastest growing bull markets. It looks good for us as a Fed, looks good for the presidency, it's good for America. Let's just keep it going. But, it's just like a drug, right? Like you kind of accumulating future debt that at some point needs to get paid, right? Yeah. And so that was the issue before. And so as a primer, Powell has an extremely hard job, number one. But they're now in a position, I think, where their hand is forced, where neither direction is good, because ultimately them raising rates, for example, just recently, 25 basis points, it only exacerbates the problem that they have with the banks.
Yeah.
And so you have to choose, okay, we can hike rates and keep fighting inflation, but in the background, more banks are going to be struggling.
Yeah.
Which means you got to provide more lending and so forth.
Yeah.
Now, that short-term lending is not necessarily damaging to the Fed or US dollar long-term, because again, they need to repay it and they are paying an interest rate on it. But the place where it becomes problematic is that you're going to have countless banks fail, which then leads to all this power accumulating with a few names, whether it's the JP Morgan, Wells Fargo, Bank of America, Citi, and so forth.
Yeah.
And the too big to fail names. And they truly need to be too big to fail, because if any of them start having trouble, again, then the government really needs to step in. And yeah, it's just a slippery slope where ultimately the government has to choose between which trust can we afford to lose, breaking up the banking system or breaking up the US dollar. And this is where things get tricky, where people project that this is a perfect lead into CBDCs, central bank digital currencies, because in a world of CBDCs, you technically don't need the banks anymore, right? Technically, you're now banking directly with the Fed, right? And so I think Powell recognizes that. He says, hey, there's an actual solution, an actual path where focus on securing the dollar. If the banks fail, we can still go to the CBDC and maintain a strong currency that we now have complete transparency over, complete control.
Yeah.
But with all that as a backdrop, crypto. Ultimately, crypto's a way for you to, one, escape the collapsing of the banking system.
Yep.
It's for you a way to avoid a devaluing dollar.
Yeah.
And it's an exit valve, so to say, from CBDCs.
Yeah.
Where you say, hey, do I really want to live in a world where CBDCs, where the government, the Fed, can track every micropayment, where they can censor every transaction, and so forth. And printing money is even easier than before, right? And so forth. And so I think that is kind of the tailwind where crypto started having major pickup in the recent weeks.
Yeah, absolutely.
Where we went from breaking every major support zone and things look really bleak to 2 or 3 days later recovering something to the tune of 50%.
Yeah. Few things there. The kind of be your own bank narrative has once again come back. And we saw that quite a few years ago, around 2017, with the first technological run, and all of a sudden now that's back because of things that are going on with banking failures. One of the other things that I wanted to mention too is just a fun aside. One of you mentioned Powell, of course, has been really tough with his decision now to continue to raise interest rates. And it's funny because the last Fed chair that had to make those really, really hard decisions is actually the guy that Powell looks up to the most. It carries around his memoir all over the Federal Reserve. Volcker, a guy that we talk about all the time on the WarRoom. So really interesting how that kind of ties in hand, as much as those, of course, 40 years apart, different times in history, but history kind of repeats itself in a way too. So really interesting. So, tell me now on a few fronts, of course, there's been a lot of big news within crypto. Do Kwon was arrested. Justin Sun is being sued by the SEC. We just talked about central bank digital currencies. But tell me what else you're seeing within the world right now.
Yeah. So the banking crisis, of course, is taking the limelight right now. But as I mentioned, I think the originating impulse that caused it was Operation Choke Point, trying to regulate crypto. And we've been seeing more and more regulation. I mean, on prior war rooms, we talked about Kraken getting slapped a fine and can't stake anymore.
Yeah.
As you just mentioned, Do Kwon arrested. For those that don't know, Do Kwon, founder of Terra Luna.
Yeah.
Justin Sun being sued, the founder of Tron. And I think he's also a lead somewhere with Huobi. And then you've had two more, which was one, the White House, said in a statement somewhere that they don't see any fundamental value in crypto. And you got to question, there's so many industries in the world that are literally illegal. There are so many industries in the world that actually don't add any value, but somehow the government doesn't waste a breath talking about them. So why is it that all of a sudden the U.S. government is deploying literally all its resources, SEC, CFTC, DOJ, White House? I mean, the list goes on.
All in one quarter.
Right, all in one quarter.
Yeah.
Why do you suddenly care so much? Why do you spend all your resources if it has no fundamental value?
Is it because they sat on their hands for too long for the last year and a half?
Well, there's the old saying, first they ignore you, then they laugh at you, then they fight you, and then you win. And I think it's very clear. Gandhi, yeah. I think it's very clear that we're in the then they fight you stage.
Yeah.
I don't think it's ever been as clear, but now you can't pass a week without somebody, getting come after. And the most recent major case was actually Coinbase, right? Where Coinbase has been the best, most legitimate player in the entire crypto space, where I believe it was also the first crypto startup that actually went public. With going public, there's so many regulatory filings, so much compliance that they go through. So many times they chose to do the right thing and leave money on the table.
Yeah.
They could have done derivatives, they didn't.
Correct.
They could have done options, they didn't. They could have done shorting, they didn't. They wanted to offer an interest-bearing product at a time when Celsius did it, BlockFi, everybody did it, but you know what? They didn't just launch it. They said, let's ask. So they went to the SEC and said, hey, we want to launch an interest-bearing product. And I believe it was a USDC product where they would have put the money to treasuries, something safe, not DeFi yield farms, nothing degen, but literally treasuries. And SEC said, can't do that. Nope. Wow. And so they shut it down. And the same guys then, I think it was a week ago or so, or 2 weeks ago, where according to Brian Armstrong, they send a note to the SEC saying, hey, we would like some guidance, some clarity on our staking products, right? And those staking products had already been outlined in their, I think it's called the S1, when they went public, right? And all of a sudden, the SEC says, here's your Wells notice. And the Wells notice essentially comes out briefly before enforcement action.
Yeah.
And at this point, the Coinbase said enough. And, they went guns blazing on Twitter saying, you know what? We're not bending down anymore. We're not bowing over anymore.
Yeah.
At this point, let's take it to court. Let's have a fair trial where normal people that aren't unelected, officials can actually decide, did we break the rules? Did we disclose everything, right? And and also, we're trying so much, I think, of regulation is intent. Do you intend to put your best foot forward, right? The fact that they did ask multiple times, how can we be compliant, right? I think if you are asking how to be compliant and then you don't get a response, then it's no longer your fault, ultimately, right? So, and I think that would be good change of pace and a good change of tone, because ultimately Coinbase, I think, it's one of the most well-capitalized crypto companies that also has, I would say, the cleanest track record. Ultimately, our chances of getting some actual guidelines is so much higher in this situation, because if they weren't willing, and for 4 years, 5 years, they've been unwilling to provide proactive information, proactive guidelines to say, hey, you haven't done anything wrong yet, here's how we'd like to see it. Or, hey, I know you're about to launch this product, this is how you should follow the rules, right? So if we can't get that, then our only option essentially is let's take it to trial and get some definite guidance. And once that happens, okay, then at least we're a step further. We're a little bit out of the gray zone where companies at least have a chance to be compliant. Because I think this is a big misconception, is that it's not that crypto companies don't want to be compliant. They just don't know how, because there's literally no instructions.
Yeah.
So if we can fix that, I think we're much, much further.
Is one of the ways that this situation plays out, do you think Coinbase goes offshore?
Yeah, and I think they've even voiced that already, right? So they've made it public that they're working on new offshore entities where essentially they would also then get into the derivative space and so forth.
Yeah.
And to me, I realized this already a few months ago, that after talking to other people in the industry, other founders, crypto is a foregone conclusion because, there's the old saying, you can take your country out of crypto, but you can't take crypto out of your country. Meaning a country can ban crypto in their country. Doesn't mean that people don't still use it, first of all. And also doesn't mean that crypto stops, right? I mean, it goes on internationally.
Yeah.
Don't forget, yes, USA is a major country. It's a world power. But you know what? So is China. And China banned crypto like 6 times at this point. And we kept chugging along. We kept going from a couple $100 to $60,000, right? And so if Bitcoin can appreciate a couple 100x's without China, then I think it can also appreciate some, without America. And also it's worth noting that there's a couple factors here. One, companies can offshore, right? Coinbase might go and so forth. Funds might go, you name it, right? That's part one. Part two is that the world is bigger than the United States, so there's massive demand for something like Bitcoin internationally. Plus, if there's currency crisis, maybe the US dollar remains strong. But if the US dollar remains strong, other currencies will fail. They too need to store value, right? And then third and lastly, even domestically, look, it's a point in time. We have balances of power in the United States, and every few years the pendulum swings one way or the other. Every few years there's certain issues current administration cares about, right? And so whether the current administration changes, let's call it the weighing of what they find important, or whether we just get a new administration in general where there is a new election happening in 2024. A lot of the biggest opponents of crypto are quite old, right? Like, I mean, Elizabeth Warren is a huge opponent of crypto, but she's like 77, right? Biden says that crypto has no value. He's, I think, 80, right? And then the list goes on, right? Well, ultimately, maybe America is going to lose, I hope not, but there's a chance that the United States loses its advantage, right? Its head start, so to say, against some other countries for 1, 2, 3 years. But I mean, Bitcoin is already 10 years old, right? Yeah. More. No, I mean, time passes. It used to be 10 years old. Now we're already 15 years old, right? 2008 to 2023. So the show goes on.
Yeah, absolutely. One last question that I want to ask, kind of while we're staying on this topic. What are some of the things that you are focusing on trades-wise in the hedge fund right now? Like, where's your head at around this?
Well, I think everything we just talked about 100% like influences the decision making right now. And what I mean by that is that you really have to simplify it down, right? So I think in a bull market, low interest rate environment and so forth, you can be big, grandiose vision in the future and tackle all these niche use cases and so forth, and forward thinking, VC capital. But I think right now, what really matters is two things. One, stores of value, which really you're only looking at Bitcoin and ETH. And I'm somebody that rarely, like for the last 5 years, we've barely ever held Bitcoin and ETH. But I also understand that if there are money flows right now, based on all the global macro and also geopolitical issues, it would flow into those two names first. Yeah. And then if you want to go further on the risk curve, I would look at core infrastructure that actually enables the onboarding of the next billion people. Because you might say, Balaji made the famous tweet where he said, Bitcoin's going to be worth $1 billion in 90 days. Yeah. The issue with that is that, first of all, Bitcoin can only do 7 transactions per second. And people might say, but the Lightning Network. Well, the Lightning Network currently has a capacity of $150 million. It's nothing. And then Stacks has a TVL, total value locked off 30 million, right? So like that's some tiny DeFi protocols, right? Like even, for example, I was a board member of Enzyme Finance, which maybe has a 50 million market cap right now. They have 70 million TVL. So Enzyme has more than twice the TVL of Stacks. And so quite frankly, if the dollar were to collapse tomorrow, the bank system were to collapse tomorrow, people just can't do their business and finance on Bitcoin yet, right? And so I think investing into properly decentralized technology that adds those extra layers where we say, hey, if we were forced to go into Bitcoin standard tomorrow, what are the different tools, what are the different like pieces that we need to make that work.
Yeah, that's super interesting. Thank you. Appreciate that. A few other kind of highlights that we can now segment into and point out. The Metaverse Fund, the VC fund, closing in 90 days. Perhaps this is a good time to overlay the beautiful trailer we have presented for it.
Hartman Metaverse Ventures 1.
ShapesXR, a collaborative creation app on Quest, to quickly explore different kinds of layouts and different designs together.
This is where VR just lets you do things that aren't even possible on a 2D screen.
DressX is the first and the biggest multi-brand retailer of digital-only clothes.
And he takes it down! Wow! 2 versus 1 situation.
The world's finally starting to see the potential of VR, and I believe that we'll be at the forefront of pushing that out to the masses.
Cathedral Studios, we're really proud to bring you The Bournless.
I'm the founder and CEO at Live. We build VR, live streaming, and capture technologies.
Red Pill's building a platform for the creation and distribution of social music experiences.
So our technology allows people to actually interact and play an entire game using only their mind.
Dun, dun, dun.
Well, if that doesn't get you hyped, I don't know. I'm honestly super excited and also proud of like the portfolio that we've compiled, because a lot of this we just launched the Metaverse Fund in January of 2022, and I announced it in December, and I think I only incorporated in October of 2021. And so seeing it go from idea to launched to now this super balanced portfolio where we have like all the words that I wrote down on deck, right? You start with literally just, these are the things I'm looking for. We wanted digital fashion there. We got DressX. We wanted gaming. We got like 5 incredible game studios.
Yeah.
We wanted virtual music. We found Red Pill. We wanted tactile audio. We got Subpack. We wanted BCIs, Neurable. Like all these things were, for the most part, in like deck number 1. And we've actually found them. And I mean, our founders have done incredible. You know, where even in Q1, for example, our teams have raised over $20 million in fresh capital in this crazy environment. Where you had DressX alone raise $15 million. Congrats on Series A. And then you had Red Pill raise $2.5 million. You had Subpack raise $2.5 million. Kind of announced yet another one. Portfolio companies about to close another $2 million round. Up rounds too for many of them. And so that's been really phenomenal. And we just said we're closing in 9 days. To be clear, we're closing the capital raising. We're going to be keeping building with our founders for like another 5 years. But this will be the final chance to actually join as a limited partner. So
Yeah. And with that, we also just made 2 brand new investments in the fund as well.
That's right.
Do you want to tell me about Mirror?
Yep. So Mirror, really incredible startup. They are a multiplayer VR first-person shooter, but that really aims to be the new winner in social VR, right? Because when you look at most social VR right now, you've got things like Rec Room, you've got things like VR Chat. And VR Chat, for example, is really so much about user-generated content from the angle that it's the users like communicating with each other, hanging out, having events and so forth, versus actual games.
But the user interface on those things are terrible.
Correct. And so MYR is actually doing an awesome job at building something that is enjoyable, high fidelity, fast paced, but it's on standalone, which is key. Because I know a lot of games, for example, they try to be on Steam VR, meaning you have to have a computer, which really shrinks how many potential players you can have. And so really looking forward to that. That was an early stage bet. We co-invested with Boost, we co-invested with DVC and a couple others. So excited to be back in Hamza.
And then the second one you actually found through a warm introduction and a warm referral from Palmer Luckey.
That's right. Yeah. So our second investment this month was Adam Montage. So the way we came about it, AJ from Live introduced us to Palmer, who, for those who don't know, of course, is the founder of Oculus, by now also the founder of Enderal. Really cool guy. We had an awesome conversation. And, one of the things I asked, look, if you were in VR right now, or if you were still in the segment, like, what is something that you would be excited about? Who are some founders that you think are brilliant? And Adam Montage was the one he brought up. And so he connected us to Daniel and Branislav, the 2 founders of Adam Montage. And what's really interesting about Adamontage is that it's a really ambitious bet and play on essentially creating an entirely new game engine and game platform, so to say, or 3D creation platform, where most of the big models, so say right now, Unreal Engine and Unity, they use polygons, right? Where essentially you're creating, let's say, a human face by having multiple different polygons that you connect and so forth.
Yeah.
And you think about it like they're hollow on the inside, essentially, right? Yeah. And the issue with that is that, one, it's not as interactable, meaning, let's say, for example, you shoot into a building that's made out of polygons. Physics-wise, it's very hard for it to, for example, break apart. You have to consciously create an animation for it. This is why in so many games, if you shoot something, they just put a little hole over it, right? And then secondly, from a scalability perspective, it takes way more computation. And also, if you ever want to go higher fidelity, you pretty much have to redo the whole thing.
Yeah.
Now, what they do instead is they use microvoxels. So the way I would think about it is you might have heard of Minecraft or played Minecraft before, where they use these cubes, they're voxels, right? Except in Minecraft, they're huge, right? And so anybody can build anything, anybody can interact with anything. You can take your pickaxe and you can hit any piece inside Minecraft and it can break apart, right? Now, Adamontage does that like on a micro level though, where you have tons of tiny little cubes essentially. And what you're now able to achieve is that everything is interactive. It's super scalable, and you can pretty much go up and down in fidelity as you want. And so it's pretty much like Minecraft interactivity, but Unreal Engine quality.
That's crazy. That's crazy to think about. And where do you see kind of these fit in within the major buckets of the fund?
Yeah. So MYR for sure under the content angle that we have, the content and IP, and Adamontage is, perfect for infrastructure. They're literally building, for me, this is a true unicorn play where there's a lot of challenges on the way, but if they figure it out, if they can make it happen, I mean, this is a deca-billion-dollar company plus. And what's really fascinating too is that, the investors in the Adamontage, for the most part, are incredibly successful angels. Like we're talking about the CEO of EVE Online. We're talking about Palmer Luckey. We're talking about like the guys that built a Battlefield and so many other games where you have the people that actually have built some of the biggest games in the world say, this is the future of game development.
Yeah,
and
that's really cool. I love that. In a few other pieces of news on the Metaverse side, Web3 side, a big release over the last few days, Ticketmaster taps Flow for token-gated NFTs to attend events. This is kind of something that we all predicted and saw, with over the past 6 months, over the last year, over the last 2 years of how NFTs can be used. Here's finally a prime example of one of the biggest ticket companies using NFTs now day to day, starting with Avenged Sevenfold. So
yeah. No, I used to be an Avenged Sevenfold fan, so for my metal days. But the cool thing is that I think most people have written off NFTs. They thought they were dead, thought it was all bullshit and scam. And there was a lot of celebrities that launched their loyalty NFTs. But it's great to see that people are now actually using them. Where, look, if you made money in 2021 on your loyalty NFTs or your membership NFTs, now go provide some value. And the fact that Ticketmaster is integrated is a huge step forward. And I think if, for example, in this early use cases, if Avenged Sevenfold sees success with it, I think a lot more people will try it.
100%. The other one was Amazon. So an email kind of hinted and confirmed that Amazon could be developing right now digital tokens, an NFT gallery, and then resale opportunities for their platform. So Amazon could become very crypto friendly over the next 1 to 2 years.
Yep. Yeah. And, can't say which, but I've heard through the grapevine potentially from some portfolio companies that that there's something real to it. So this is these things are in the pipeline. Amazon is actively working on some kind of NFT marketplace. And if if Amazon joins the game, if Ticketmaster joins the game, you already have PayPal and Cash App and you name it. There's more and more big tech companies that are willing to invest and build on these technologies. In a bear market when everything's already down, 100%. Right? So this means they're not just doing it for the headline. They're not just doing it for the hype and the approval stamp. They're doing it because they think there's actually a path for us to either increase maybe user retention or generate more revenue, right? Because that's the main thing that drives these companies.
That's a really good point. That's really well said. Yeah, absolutely. Especially like now during the bear market, they can focus on a lot of other things, but because they're actually doing this and focusing on crypto right now, it means they really have a future slated interest in the space.
Correct,
Awesome.
because also right now would be a time where nobody would bat an eye if they kill off any Web3 initiatives, because we've seen this, other companies do this, right? And so the fact that they have an easy out, they're choosing not to, instead they're still building or even starting something new, I think that will be some of the tailwinds as well that will guide us into the next bull market.
Yeah. Last thing that I want to talk about today is where we're at with the firm right now. This is a big week. You have the American Metaverse Awards on Thursday.
Right. Yeah, so I'm giving a keynote at the American Metaverse Awards. It's here in Miami, and we've also been nominated as a top Metaverse VC fund. Huge. And so we'll find out whether or not we win on Thursday night. And then you yourself are actually in New York this week.
Yes, heading to New York tomorrow for a talk on Wednesday about capital formation throughout the bear market and leveraging technology to help do that. So
that's at Hedge Week.
It's at Hedge Week, yes. It's at the second of our 2 Hedge Week conferences. So you're at the one in the beginning
Amazing.
of the month too for you.
Things are getting busy. We're like both of us on 2 different cities, both,
Starting
showing some love to the industry, and there's more coming up too. We got confirmed speaking at NFT NYC April 11th or 12th. Then we're hosting our first summit. That's we're building up right now. We've got some incredible speakers confirmed. And then I'm going on the road for the first time in 3 years. I'm not a U.S. citizen. I'm on a green card, and the funny thing is, my green card was expired for like 2 years. I'm still legal, however, I can't leave the country, and so finally I can leave the country. And so going on road shows, meeting with some of our Hong Kong LPs, some of our Germany LPs, and that will be awesome. And so
we have one last thing in the works in the kitchen right now. Tell me about it.
That's right. Well, I've launched my first fund in 2018. I've launched my second fund late 2021, and we might be cooking up something new. However, we're staying within our focus. It's still going to be digital assets, still going to be metaverse. In fact, it's going to be a little bit of a blend of the things we've already been doing. Okay. But I've been thinking about a way to make these investment opportunities a little bit more accessible.
Sure.
Because our minimums have gone up quite a bit, where it's really out of reach for a lot of people. Plus, in times like these, people don't necessarily want to put that much money into these risk buckets. And so, been developing a new product that we might announce soon. But if you want to be in the know of when that actually drops, as usual, we created a new email list where if you want to learn more, check out the link in the description where. Once a week, I share some of my insights on what's been going on in the markets, what we've been doing. And as it becomes available, you will be the first to know. So don't forget to check out the description. To close things out on, I think there's something worth sharing. I read a post this morning where it talked about that if you started investing in 2020, you've been investing and trading through the biggest pandemic in 100 years. You've witnessed the balance sheet expand by $4 trillion. You've witnessed zero interest rate environment. Essentially, for the first time virtually, we saw it getting nuked on one day to zero. You then experienced the fastest rate hikes in pretty much 40 years. You experienced oil, I believe that was the first time, going negative. I remember actually watching the charts that day. I think that we bottomed minus $32 to now being over $100, one of the highest prices in history. And so many more crazy things have happened. Bank failures, supply chain issues, record high inflation. All these different things have been playing out in just 2 years. They're not even mentioning things like international conflicts, whether that's China, Russia, Ukraine, and so forth. And I think while it is a challenging time to navigate, I think the people that are paying attention in these cycles, that are doing their best, surviving, will probably be some of the best investors and traders for the coming decades, because the kind of training you're going through in these unheard of scenarios essentially prepares you for anything that can at some point happen.
Yeah, that's well said. It's a great way to frame it too.
And so as crazy as these times are, I think as long as you stay in business, as long as you keep pushing, as long as you keep looking for the edge, because it's also worth saying that when you have these outlier events, when things are so unusual, that's also where a lot of incredible opportunities hide. Why? Because everybody's confused. Everybody is so shocked from the big headlines that sometimes these idiosyncratic opportunities can hide in plain sight. Why? Because most people aren't looking.
Yeah.
And so even though, the past few years have been a roller coaster running an investment firm with this unheard of environment, I honestly couldn't be more grateful, because it's what a time to be manning a firm, what a time to be, get to participate in this, learn from it, and, with every day getting better. And excited for what the future holds.
Yeah, 100%. Love that. And with that, we'll see you next time.